A few years ago, a luxury apartment in London was quietly purchased, not by a billionaire, not by a company, but by a country. No flag, no announcement, just paperwork. And that's the part no one tells you. Nations aren't just trading goods anymore. They're buying the world itself. Right now, governments are competing in a silent race, not for land at home, but for assets abroad. Skyscrapers in New York, ports in Greece, farmland in Australia, data centers in Northern Europe. They're doing it through something most people have never heard of: sovereign wealth funds. On paper, these funds are simple. A country takes excess money, usually from oil, trade surpluses, or foreign reserves, and invests it globally. Think of it as a national savings account. Except instead of holding cash, it buys companies, real estate, infrastructure, anything that holds value. But here's where it gets interesting. The largest sovereign wealth funds aren't just saving, they're reshaping markets. Norway's fund alone controls over $1 trillion. Saudi Arabia is deploying hundreds of billions to diversify beyond oil. Singapore has been doing this for decades with surgical precision. And increasingly, they're all circling the same prize: global real estate. Why? Because real estate does something currencies can't. It anchors wealth to something physical, something finite. Land doesn't inflate away. Buildings don't vanish with a market panic. In a world where money is constantly being printed, hard assets start to look like lifeboats. So these funds move quietly. They buy office towers when markets dip, logistics hubs when supply chains tighten, entire neighborhoods when cities need cash. Step by step, deal by deal, they accumulate. And here's the uncomfortable math behind it. When a sovereign fund buys property in a major city, it's not just an investment. It changes pricing power. It can outbid local buyers. It doesn't need quick returns. It can wait decades. That patience distorts the market. Prices rise, not because locals can afford more, but because global capital can. The result: homes become assets first, shelter second. Of course, the public story sounds different. You'll hear about long-term investment strategies or stabilizing global markets. And to be fair, sovereign wealth funds can provide stability. They don't panic sell. They think in generations. But stability for whom? Because while these funds are playing the long game, cities are dealing with the short-term consequences: rising costs, shrinking ownership, and a subtle shift in who really controls the ground beneath your feet. There's also a deeper irony. Many of these funds exist because of globalization: oil exports, trade surpluses, interconnected markets. And now they're using that same system to quietly buy pieces of it back. It's not colonization in the old sense. There are no armies, just contracts. So zoom out for a second. If nations continue buying each other's infrastructure, housing, and land, ownership starts to blur. Economic power stops matching geography, and influence becomes less visible, but more permanent. Because once you own the assets, you don't need to control the politics. You just wait. And that raises a question no one really has an answer to yet. In a world where nations are buying pieces of each other, who actually owns the future?